Hi, everyone. I'm gonna give everyone a few seconds. We're having lots of people join at the same time. We'll wait until we have what looks like a slowdown in the number of participants trickling in, and then I'll go ahead and get started. Okay, it looks like we have a significant number of people on. Welcome, everyone. Welcome back. If you attended the last session that we just had, this is session 2 of SCAMP's 37th annual conference. This session will be recorded, so you'll be able to revisit the discussion or share it with your colleagues afterwards. So if there's anything you don't capture on your notes, don't worry about it. Before we get started, I'd like to offer just a couple of quick remarks. With federal budget cuts and policy shifts looming, affordable housing is under real pressure. It's hard to hear narratives that question our impact or suggest we're wasting tax dollars or not doing enough. But here's what we know. Our members are working tirelessly. You're working tirelessly, no matter what approach or perspective of the industry that you're in. Every win, no matter how small, matters. And we see the impact up close. Families finally finding safe homes, lives being transformed. That's why this conversation is so timely. As federal resources grow more uncertain, lenders and investors become even more essential to moving projects forward and keeping affordable housing viable. Today's panel will explore those partnerships, how we navigate challenges, adapt to shifting conditions, and keep building the future of housing together. With that, I'm pleased to introduce our moderators for this discussion, Yasmin Tong, founder and president of CTY Housing, and Daniel Huynh, vice president at CTY Housing. Yasmin, Daniel, over to you.
Thank you, Emily. And everything you said is so true. I think what we'd like to do is start off with asking our panelists to briefly introduce themselves, and then we'll get into the questions. Why don't we start with Debbie, and then Debbie, you can just popcorn it to whomever you would like to pass the baton to. Thanks.
Thank you. Good afternoon, everyone. Great to be with you all and happy SCAMP. So my name is Debbie Koski, and I am the Director of Community Development Finance at First Citizens Bank, and I manage our lending team in California. And I will pass it to David.
Thanks, Debbie. David Dolagite, Director of Acquisitions at Merit Community Capital. We are a nonprofit, California-based syndicator for tax credit projects. We provide equity across the state of California and are exclusively active in California. I'll pass this off to Ari.
Hi, everyone. I'm Ari Kameyama with JP Morgan Chase, based in LA, or I'm working on a debt side, so doing construction loans, construction to perm loans, etc. So look forward to talking with you all.
I'll jump in. Chuck Sinke with US Bank Impact Finance. I also work on the debt origination side. US Bank is a lender and investor in affordable housing projects across the country. I work here in Southern California, Arizona, and New Mexico for our team.
All right. Well, we'll get things kicked off. And this is a question for all of you. What trends are you seeing among borrowers and the developments they're bringing to you? And how is that changing your underwriting process and overall assessment of risks in affordable housing as an asset class? Debbie, you want to go first?
I can jump in. Overall, affordable housing remains a strong business. I think everyone knows rents are rising and demand for affordable housing is higher than ever. And we have such an amazing, strong ecosystem of developers that's great at meeting that need. And so, risks are going to change slightly, trends are going to change slightly, but I think I just remain like so grateful to all of our developers and their tireless work. So just to name a couple things that I'm seeing, we're definitely seeing a shift towards deeper affordability. And of course, we're competing for more and scarcer local funds such as Triple H, NPLH. And so as we see developers starting to kind of move into these deeper affordabilities, something that's important to me and to First Citizens Bank is that we're taking a thoughtful approach to serving tenants well, and developers who are new to PSH, I would really want to see a thoughtful approach to the building design, the services, and also, would have more questions if you're kind of, moving into those deeper AMIs for the first time. And then local experience is so critical. And we work with a lot of place-based developers, and you know that better than your banker. But entitlements are hard, permitting is hard in places like LA, Long Beach. So I think more than in the past, we're looking for good experience in jurisdictions where projects are proposed. So there's other trends we're seeing, but I don't want to name them all. So I'll pass it to one of my colleagues to add to that list.
Yeah, I can just add a couple thoughts. And I know we're gonna talk more in detail about some of these things in a little bit, but more recently, I would say with some of bond deals that received their tax credits and bonds midway through this year, we're seeing a flex down in the bond allocation and maybe some more taxable debt on some of these projects. So we're seeing some more interest carry and maybe some different terms on debt for some of these deals. Kind of to Debbie's points, a little more questions when it comes to certain tenancy types and experience of our developer partners in working with those specific groups of tenants, and how the referral processes work, and kind of experience in navigating some of those things. And then also, I would say a little bit of I've noticed a lot more questions and a deeper dive into our developer partners' overall portfolio and the health of that over the last few years, and how our sponsors have been able to support some of their projects through some tough times, or maybe some operational concerns, and then just looking into what those pipelines look like for the future. And then I'll pop it over to Aria. It sounded like you wanted to add some too.
Yeah. Yep. As Debbie said, our industry stays strong, and we keep, seeing all kinds of deals, and, PSH, family, seniors, large, small, rural, urban, anything you name it. But one thing I would note is that, I'm on the origination side, but our underwriting, or, our review will be driven by what we see in our portfolio and existing deals, right? And we spend a lot of time on, like modifying the loans, extending the loans, and, kind of things happen on the construction side as well as operations. And then especially on that, operating cost side, we've seen a huge jump especially in the past year, like 2023. Many of the developers had portfolio with, good operating properties, and all of a sudden 2024, a lot of properties were struggling, right? Insurance cost is one, but sometimes we just cannot, assume that expenses will increase by 3% every year. And, also there were some issues with the revenue side, right? On rent collections, and, some tenants that, had problems, etc. So we're a lot more careful looking at the operating costs, and, what are included in operating costs, and what the assumptions are. So, just, prepare for more questions. And also, as Chuck said, we're paying more attention to developers' REO schedule. We're paying a lot more attention to the sponsors' experience and the strength in managing properties. So, it is not fun to go through all those details at the beginning, but that's what we do. And, and it's just, we also see the developers have, managed, strength to manage all those, issues. And that's good things, for lenders, right? So that's something that we look at also. And I guess also on, it's true that there are a lot of projects with, some lower LMI deals, but, we'll look more carefully on that deals with 70% and 80% MI units in some markets. It's, there's softening we see, and we would like to see good discount to market on those units. So.
Yeah, I'd add to that. In addition to the REO schedule stresses we're seeing challenges to sponsor liquidity. So, we all have metrics we use to determine kind of ratios between kind of immediate liquidity that the developers have access to through corporate cash, and other liquid investments as against their kind of size of the construction debt, the construction contract and the overall size of the project. But even if we're seeing sponsors still able to satisfy those metrics, we're paying really close attention now to kind of the year-over-year changes in cash liquidity at the sponsor level, because we're seeing more and more sponsors needing to support their portfolio deficits through their own corporate cash, and that is a unsustainable track if it continues. So like when you're looking at your deals, you have to start really, and my advice to sponsors is you're going to have to get used to like looking beyond just your project and get more comfortable understanding your own organization's kind of where you're going right now with your kind of year-over-year cash trends in your own REO schedule, and making sure that the REO schedule that you're kind of presenting to banks and investors is clean, meaning you're keeping it current, it's organized, and has a sufficient amount of information for us to be able to really understand what the trends are amongst the various deficit projects in your portfolio. And if you have those that are significant, be prepared to provide answers as to what the plans are to stabilize those properties long term. And then, on the project side, ditto to what Ari said around, trends on operating expenses. We're seeing are, kind of above the 3.5% folks have gotten used to. I think the kind of like TCAC requirement is a very low floor for kind of underwriting at this point. Particularly, insurance costs, which, continue to increase well over that year over year, as well as payroll, which seems like it's finally starting to moderate, but we went through a period there where payroll costs were exploding, and kind of maintenance costs on older properties. And then, specific to PSH, I think the one thing I would add is folks might start seeing a lot more digging into from investors understanding how your services plans are being structured and how they're being funded. And from what specific public sources, if they are coming from your county or city, what the derivation of those sources are, because we're imminent on receiving kind of national guidelines from our trade groups that all of the upper tier investors kind of look to, specific to PSH in response to nationally a lot of PSH projects are under stress, and there's kind of increasing concern amongst the investor base about the risk of those types of projects, particularly those which were financed with perm debt.
Thanks. I'm curious if before we move on, I just want to see if there's any follow-up comments from any of the other panelists or advice you have for borrowers that are bringing in new projects to you. All right. Well, then Daniel, please take the next question.
I'll go ahead and take the next question. Thanks a lot for our panelists in talking a little bit more about the stresses that we're seeing in the REO schedule. You're looking over liquidity. You're also looking at just the overall competency and the experience and health of sponsors. I think it all just boils down to, credit, collateral, capacity, and character. Our next topic is about interest rates. So this is, we've all collectively have seen kind of a roller coaster ride, starting with 2022, and then finally, I think the past 6 months, it's finally plateaued. Finally, I think the whole industry requires a little bit of predictability and stability for us to really grow and make our work happen. I'd love to hear a little bit more about how the high interest rates have impacted or will impact investments in affordable housing.
I can go first again. It's my turn. High interest rates, I'm really sorry, guys. I know it's been hard. And then I also want to say, like, when you've been doing this work long enough, you just have to have tremendous appreciation and respect for the resiliency of our field. We had like the downturn of, 2008 or, the crash. We've been through a global pandemic together. Like we can do hard things, right? But looking back in the last couple years, like Daniel said, it was really tough when rates started rising quickly, and so one of the first things we did is start offering derivatives for the first time. Our clients were like, "We need this," and we were like, "Okay, shoot, you do need this." And so First Citizens Bank started offering swaps and caps. We're grateful for the increased stability. And we've had a little time to adjust, and we do offer a fixed rate product, so that's been well received. And then we have a little control. We can't change the reference rate, but we're in charge of the spread. So we're, like sucking it in and taking as skinny a spread as we can to help out clients. But I guess kind of looking at the field more broadly, we'll get through this, but there are a couple things that kind of have me a little worried, and that is that the higher interest rate costs and just overall higher development costs mean that the ask to local funds are getting bigger and projects are getting backed up. And so this isn't an emergency, but over time, I think it's going to take a toll on the developer community. We need those projects moving. We need development happening so folks can collect their fee and continue to remain profitable. And the value engineering is always inspiring and creative. We're seeing that folks are doing what they need to do to get projects to work. Sometimes it means being scaled down, whether that's unit count or maybe just a smaller community space. But the deferring fee has me worried. Like, we want developers to be collecting their fee. We were talking about, the importance of cash earlier to sustain, like real estate portfolios that might be kind of stressed a little bit by increased operating expenses. So yeah, it's people are creative. We'll get through this, but also it's a tough time.
I don't know if we're going in the same order we did on the first question, but I would echo that and also say, there were some creative structures that kind of came out of, right? So derivatives were one that kind of helped give stability throughout a construction period where your rate might be variable. I think the public offerings on bond deals helped to kind of bring a different way to offset maybe interest rates during the construction period, and maybe earn investment income or increase some basis to try and get additional equity into deals. And maybe those won't be as popular going forward given some of the changes to the 50% test, but there was a certain creativity to try and offset maybe higher interest carry and higher interest costs. And then of course I think it did kind of put a lot of stress on soft funds, especially long-term soft funds that were making up for, higher rates on permanent loans, because the higher the rate, the less perm proceeds that can come into the deal, and now you have to find sources to try and offset that that are long term. So, um, I mean, without having a crystal ball and knowing what interest rates are going to do, at least there has been some relief in the last few weeks on interest rates, and indexes have gone down a slight bit, but uh, I would love to tell you that would continue. I just have no idea, and I'm not sure. I'm not sure how long that trend continues, or if interest rates will remain steady for any period in the near future.
Agree. Right. We're kind of scared to say where it's going. But one thing I would add is that, the derivative products, that was super useful when the rates are going up super quickly. But now I see that, probably the rates will go down, but still people kind of like that certainty or, predictability. So I still see, clients, still opting to get caps, because you never know, 30 months, 36 months, you don't know where the, interest rate will be. And also you can kind of manage or reduce that, cushion. So I still see that, coming through. That's kind of interesting for me as well.
So yeah, I know on the equity side, Daniel, I'd say, when we talk about rates, it's like which rates, right? And the press likes to focus on what's the Fed going to do. And I always remind folks, like the Fed controls overnight lending between financial institutions, and so its lever is mostly on the short end of the curve, meaning, daily floating interest rates and the like. So, when you see the news and what's the Fed going to do for developers, it could be positive or negative towards your variable rate construction loans, right? But is probably not going to impact that much on what you can leverage as perm debt through perm loan facilities, which are much more a function of like the long-term bond market, which has been much slower to come down and will likely be slower to come down since it's more driven by inflation expectations and overall market demand for U.S. government debt, which has been softening, in part because the Fed itself stopped buying long-term debt that it was doing during quantitative easing in the 2000s and through the pandemic. So, all of which is to say it's probably gonna get a little better there too, but not as much as it might on the short end. The jobs reports are awful, and the leading indicators for inflation are okay-ish, which would all presage, the Fed to be able to have room to cut rates now. For equity, the impact's been, the longer end of the curve is like kind of more predictive of what banks see as their kind of cost of capital for providing equity to syndicators like me in exchange to buy credits, right? So we've seen this kind of sustained period now for several years of pricing falling, and it's driven by multiple things. But one of the things it's been driven by is the fact that banks' cost of capital has remained high, and it's been a function of the fact that rates have stayed so high for so long. So on that long end, not on the short-term rates, but on that long end of the curve, since the 10-year Treasury is kind of the closest equivalent banks have for like thinking about the value of a 15-year credit investment. There's a long way of saying I'm not seeing a lot of room for pricing to like go up anytime soon.
Well, let me turn it over to Yasmin, unless there's more to say about interest rates.
Thank you. Well, there are a lot of big changes afoot. I think folks have heard now about the 50% test for bonds now going down to 25% test, and that the corporate tax rate has decreased, and also that Fannie Mae is doubling its investment in tax credit equity from $1 billion to $2 billion. So, I mean, these are all good things, but they all have an impact on investor demand. And so, David, would you like walk us through how all these different
Mhm.
uh, you know, issues are affecting your world and how you're evaluating projects and what you're willing to pay for projects, and also if you could talk a little bit about like upper tier investors and how all these things are going to be affecting their behavior.
Sure. Yeah, no problem. And I'll start with the sunshine, and then I'll talk about, but don't forget to bring an umbrella. Um, so good news, right? So in the OBBB, we have a number of provisions, either directly connected to the credit program or to kind of real estate generally, that I think are positive. They're positive, right, for us as a affordable housing industry. One is 9% credits, right? So the 9% credit ceiling, the annual allocation, 9% credits that each state is eligible for, that ceiling was increased to 12.5% permanently. So, California, TCAC will see, 12% more, more 9% credits available each year. So that's positive, right? So a few more projects are going to be able to be funded out of our 9% program. On the bonds, the 50% test was permanently lowered to a 25% test, which means you only need half as much tax-exempt bonds from SIDLAC in order to qualify your project for 4% credits. Again, it's positive, right? So SIDLAC now is going to be able to, in theory, depending on how the SIDLAC kind of structures all this, could potentially award twice as many projects, roughly, bonds. I have a feeling it's not going to quite fall out that way, but close, right? So, for folks who have found themselves jammed up, having to put in repeated applications, right, with the hope of getting maybe lucking into a bond award, your odds, I think are going to go up now, which should help with like people's backlog pipelines, and that's a positive. And then, not directly related to the credit program, 100% bonus depreciation was brought back for personal property and site improvements. It was, we were in the middle of a phase down from it. So that is going to increase the amount of like upfront losses that investors are able to take, which, generally is positive for pricing, right? So folks might be able to buttress, the credit pricing a little bit through the fact that we got bonus depreciation back. And then, Fannie and Freddie both each had their equity investment kind of capacity increased $1 billion each. So for a combined, $2 billion more in equity capital coming out of Fannie and Freddie combined nationally, right? So I think that's going to be helpful. It might be about, enough to cover 10% of the market or something like that, which is great because we're going to need it in light of the 50% test being lowered, right? Because now there's going to be just more credits in the market. And Fannie and Freddie, have generally, right, been targeting rural deals in particular under their duty to serve plans. So, if you've got not exclusively, but I think if you're a rural developer, you're doing rural deals, the increased Fannie and Freddie capacity is a positive. So those are all good things, right? Like more people are going to get their projects built. We're going to see more affordable housing built. I think what folks need to think about as they're planning, right, for their projects now in light of all this is the biggest unknown right now is, can the market absorb all of this potential increased credit supply? We're, like I said, 12% more 9% credits, and then potentially up to a doubling of the amount of 4% credits that are like being sold into the market in California every year. And right now banks are all largely meeting their Community Reinvestment Act demand, like their obligations under the existing supply of credits. So, the additional supply is going to have to be absorbed either, by more likely than not folks who are just purchasing credits on a pure economic basis, which for like the folks in the audience, what that means is, it's from investors who don't want to pay as much. They want to pay a lower price per credit, and they demand a higher yield because they don't have a other regulatory reason to buy the credits. They're purely buying it for tax purposes, and it may have to come from non-bank participants in the market. We may need to be able to draw in insurance companies or major corporations who are currently not very active in the credit market because they can get investment tax credit or other tax structure needs met more cheaply, right, for them. So I think we're going to see like downward pressure on credit pricing potentially, even despite Fannie and Freddie bringing in $2 billion extra nationally and some of these other things I said. So like I think when you're looking at your pro formas, like for new deals, you should be conservative at least with yourself on your pricing assumptions right now until all this like shakes out, so that you don't find yourself going out to market with a budget based on a certain price that you fall really short of, and then you've got a big hole to fill. I'm starting to see that already in some deals, and it sucks. It's no way else to put it. It sucks to be a
Yeah.
developer and all of a sudden be like, well, I don't get a developer fee now to make this deal
Mhm.
work, and that is not a position any of us want anyone to be in. know.
Do you have a recommended range for underwriting? Like, let's put it this way, if you were a developer
Uh,
modeling a project right now, what kind of pricing would you be using
low
to
low
price?
80s.
Low 80s.
Yeah.
Okay. All right, you heard it here first, folks. Low 80s.
All things change depending on the CRA market you're in and all that, and the kind of project you have too. I think if you read between the lines, everybody's been saying, well, PSH is kind of a little higher risk, so people are there's probably less demand for that than if you have a plain old large family project with no set asides in a strong market, like it's and your balance sheet's really strong. So we're definitely seeing increased bifurcation like I saw last year and the year before between deals keeps growing, and my peers are seeing that nationally, meaning there's this little subset of deals up here that are high CRA need areas. The project's pretty simple, right? For our purposes, right? And the developers have a strong balance sheet. They're still getting okay pricing, but then it like drops off rapidly from that, and we're losing kind of like a middle tier pricing range. It's more of a cliff thing like this rather than a gradual between deals. Plan for the worst, hope for the best.
Thanks for that. Any other panelists want to chime in on this? I know David Triller, equity expert here. Last chance. All right, we're moving on. David covered a little bit about the CRA, or the Community Reinvestment Act. We know it provides fair access to credit. We know that it helps to counteract discrimination and redlining and encourages community development. Just recently, there was a rescinding of the 2023 update to the Community Reinvestment Act from last October. I'd like to hear a little bit more from our panelists as to what that type of impact to the regulator's decision not to proceed. So love to hear some of your thoughts.
I can start. So, at First Citizens Bank, we have CRA and compliance, but we are going to be prioritizing affordable housing. I think, like we've discussed earlier, it's a great business. It's a great community investment. We have many long-term partnerships. So, I just want to say that CRA isn't the only reason we're doing this work. And we've had a couple years of really uncertainty. We thought the CRA rules would change, and then they weren't going to change. And banks don't do well with uncertainty. So as a lender, it's really great to have clarity. We want to do a good job. We want to comply with all the rules that govern our work. And it's when you know the rules of the road, it's a lot easier to drive. So I think that it's tremendous to have that stability.
Oh, good. Sorry, Chuck.
Well, I was just gonna say, I don't see like a rescinding of that 2023 piece making any banks want to shy away from doing affordable housing business, right? Like I think like Debbie said, it's a good business and a good industry to be in. And we had, one of the largest um, increases to the LIHTC in many years this year, and uh, I think banks realize that this is a good space to be investing and lending into. So so I don't see that rescission necessarily, prohibiting banks from continuing to do this work and this business. That said, I mean, CRA is always a cyclical thing for a lot of banks and investors because it's usually a 4-year cycle. So banks will have different needs to meet their CRA obligations at different periods of time. So as far as being an investor and looking at certain projects in certain areas where financial institutions need to meet their CRA needs, that's kind of an ongoing thing as well. So sometimes banks will be very targeted in where they're looking for investment opportunities depending on where they're at in that CRA cycle. And I think that will just continue now that there's clarity to how CRA is going to operate in the near future.
Yeah, I'd say I think the impact means the quo is status, right? Like we haven't changed anything. It is the system we have been living in all this time. So and I think that without getting into the weeds on it, like there was concern that the proposed changes, right, were going to potentially be less great for California than some other parts of the country, and in particular maybe less great for kind of urban coastal markets, just because of the increased flexibility the changes were going to provide banks on how they could satisfy their CRA need. So like, if you're in LA County, I think the fact that it was kind of pulled back is probably better than not on the net. Yeah. And you should always, if you ever find yourself bored at night, send a postcard to your elected official telling them you love mom, apple pie, and the Community Investment Act. It is the single greatest tool for keeping our pricing up in California.
Yep, I just echo, Debbie and Chuck. Yeah, we're not, we have CRA needs everywhere in California, but we're not really driven by it, So it's a good tool to have, and we'll continue to monitor. But we'll continue business, as usual. So.
All right, thanks. Well, when I give the advocates who led the way for La Casa and Measure ULA to want to just thank them for their work. But it also introduces some new things that we haven't really dealt with before in terms of social housing. And I think the idea is that a lot of those social housing developments aren't expected to use tax credits necessarily, and yet are also striving for much longer affordability covenants, sometimes affordability in perpetuity whenever that's practicable. So, I think our audience would be very interested to know about your thoughts about these kinds of housing projects, and if your underwriting approach would be changing, given that 80% of the total development cost is being proposed to be paid by the city of Los Angeles for some of these developments, at least in this current round of funding for ULA. So the floor is open. Love to hear what you have to say.
Hey, I love a creative loan structure. I'm a bank nerd, so anytime there's something that kind of comes up that's creative and is looking to build units without maybe tax credits or using private equity or using available sources of capital at the local government level, state government level, it's a chance for us as a bank to understand, the perceived risk from a different angle, right? So depending on how some of these deals are structured, you know, some of the key items that we would look at in a tax credit project would be a little different, right? If it's private equity coming in, it'd be structured more kind of a traditional, like a traditional commercial real estate project. If it's a funding source coming from the city where they're looking at 80% of the development costs to be covered by that, we would just need to understand how that comes into the project. And then, us banks like to be in senior position whenever we're putting capital into a project. So we'd have to understand, how that looks, understand regulatory agreements that might be in place that would need to also be in senior position. So I think there's a few different factors that can go into it, but one thing I've always appreciated about being in this industry and being in the space is the creativity that's required to even put a financing stack together to build this type of housing. So I think to the extent that there are different models that we can look at as lenders and try and work with those groups to see how best to fund them, I'm open to it. I'm also open to just talking through ideas, and I feel like sometimes that's 30% of what I do anyways, is just talking through what could be. So always happy to look at new structures.
Yep, I totally agree. And it was, I guess everybody was on the prior panel, listening to the public funders, but this is great news for LA, and this is probably one of the few, markets where affordable housing production will grow substantially, right? So that's very, very exciting. And yeah, we as lenders, we want to work with, public funders and on creative solutions. And, we did that with HCD on the accelerator program a couple years ago, and that was a great success. But we always, see different issues, right, when different structures introduced. And in that case, okay, no LIHTC, great. But then like, oh my God, no investor to, look after that project for 15 years, right? So we're like on the hook 100% as lenders. So that was a new thing to kind of realization, right? Also, I guess, we still, wait to see how that's going to be structured. We're open to, to be engaged. But also, we're regulated institutions. So some of the things, we don't really have flexibility, right? Like LTV or subordination issues. So we definitely need to, look at the details. But yeah, I'm very excited, for those new funding sources.
I'll just echo what Chuck and Ari said, like, please include us as these new programs are being developed. It's so critical that innovation is done collectively as an industry, bringing stakeholders together. Because to Ari's point, like, just because we want to do something doesn't mean we can as regulated institutions. So collaboration is essential. And then I'll also just say we all agree it takes too long to build a LIHTC project. Like, it is bananas. And so any innovation that we can achieve, thank goodness. And that's one of the reasons First Citizens Bank is a big supporter of SCAMP and other organizations who are really kind of driving policy changes, field innovation. It's just not enough to settle for the way things are done. So I'm really excited about any innovation and how we can support it.
Great, thank you.
Well, you heard it here. A number of our lenders are open for business and very interested in moving your projects forward. You will see them at SCAMP tomorrow, so make sure you bug them and drop a business card. I want to move towards talking a little bit more about project-based vouchers. It's a really good topic given just essentially the lack of additional project-based vouchers. I'm curious as to you folks, y'all as lenders, what kind of lending patterns, practice, underwriting kind of guidance around specifically permanent supportive housing that you can share? And then also in addition to that, what are you seeing in the market given the lack of PVVs? And how are your clients and your borrowers now underwriting new deals?
Well, oh, go ahead, Ari.
Oh, go ahead, David.
You know, on the back half of your question, Daniel, you know, with PSH, you know, we are outside of a few like really large cities, you know, who have some PBV supply. You know, often what we're seeing is PSH being funded not with an ongoing operating subsidy, but with, you know, a capitalized operating subsidy reserve, and we've gotten, you know, comfortable underwriting those. Particularly the HCD ones. You know, in part, you know, just speaking of from my perspective as an investor, right? We're in for 15 years. The coasters are sized over a 20-year period, right? So we've got like a 5-year buffer, and that's in part what we rely on as kind of risk mitigant in the event that the operating expenses over the life of the coaster period are higher than expected. You know, one thing we're also seeing, and I think LA is starting to do this too now. We're working on a few in San Francisco. Is you know, local housing authorities getting into the Faircloth to RAD program, which allows housing authorities to get additional project-based Section 8 voucher authority if they are currently under their Faircloth limit. Which is, you know, it's a federal limit each housing authority has on the number of public housing units it's allowed to own. It dates back to the Clinton administration. And, you know, a lot of housing authorities have either demolished through Hope 6 or they've ratted their portfolio such that they're below the Faircloth limit. And the Faircloth to RAD program is allowing housing authorities to actually get access to an additional voucher authority pull from HUD through the program. And we're starting to see a few of these transactions and working on them and getting comfortable underwriting those as well. And like at least at Merit, like we still have a pretty strong confidence in the Section 8 program. Survived a long time. It has a useful political function in that it has a diversity of interested parties and users of the program that are across the political spectrum, much like the credit program, which helps for its kind of long-term stability compared to, you know, some of the direct like grant programs from HUD, which are always more volatile depending on who's in charge in DC.
Yeah, David knows, you know, he's a professor on affordable housing, right? That's so interesting to hear. So yes, and you know, in terms of app rents, we definitely are, you know, we can definitely underwrite, but we are more careful on app rents over market. We used to be pretty lenient on, you know, especially in certain markets, if it's 20% above market or whatever. But now the, you know, concern is that, oh, during the 20 years is that, you know, is the housing authority will, or HUD will continue to approve increases in rents. It may, you know, not approve the increases, you know, 3% or 2%, whatever. So that's going to be more carefully looked at the initial underwriting. And when it comes to PSH, no secret that, you know, PSH properties are struggling statewide. So definitely we need the vouchers. We're seeing some other type of operating subsidies. Look at it very, very carefully, especially if it has, you know, commitment for, you know, 5 years or, you know, 10 years. That's a really difficult, you know, issue to overcome for us, you know, if we have a perm debt. So, yeah, especially on PSH, you know, we don't like to see non-PSH units subsidizing PSH units. You know, if that PSH units don't have, vouchers. So it's just different issues that we look at. It all depends on the project, but we're looking at carefully on the operating expenses as we discussed before, insurance or service budget, payroll, like how many full-time staff, employees on the property, and also the R&M. It tends to be much higher looking at the existing property. So, and also security plans and lease up, it's a major concern as well. So, but we still see many, I see that developers are being more careful because of their, portfolio of properties that have issues, right? So it's a good thing to see like higher OPEX assumptions and, detailed security plans or lease-up plans. It's good to see, but those are all the things that we'd like to look at the, beginning. So.
And I'd say we raise a very large eyebrow at like a project that has maybe 10 or 20% PSH, and the proposal is to cross subsidize with the other rents, like where there's like either no operating subsidy being provided for those units and no COSER. Like it's going to get a really, really sharp pencil on that. I don't really like to see that. Completely unsubsidized open PSH units, and an argument that, oh well, we got the 60% AMI rents will cover the cost to operate those units. We don't see that happening in our portfolios like that. So the proof testing is a pretty high hurdle on that kind of stuff.
Right.
Yeah.
Anyone else on PBVs and PSH? All right. We have a few questions from audience members and a few minutes left. So why don't we try to get through some of those? Daniel, do you want to walk through? Let's see, it looks like we have about 4 questions, and I also want to invite the audience to post more questions in the Q&A if you have some additional questions you'd like to ask. Now's a great time.
Sure. So the first person wrote, what is a more realistic escalator for expense? What is a more realistic escalator for expenses? I think this person is trying to ask if they should be underwriting at the typical 3.5% escalator. What are your thoughts here?
I don't think it needs to be, built in now, right? It's just we need to have kind of higher operating expenses to, because the project will close construction financing, and 3 years later it will convert. By then, what the expenses will be, you cannot be super tight. It's really hard to convert, in 3 years. But yeah, I didn't mean to say that escalator should be different, But I also see deals with declining DCR during that prime period. Maybe, you need to build in some cushion as well.
Yeah.
Let's talk about that a little bit more. What type of underwriting are you doing now that you weren't doing, say, 3 years ago around the OPEX? Are you now asking for copies of contracts, or kind of you have your internal database that you're kind of comparing to? Maybe if you can answer that, I think our audience would want to kind of hear a little bit more so that they're more prepared when they come to you and they're trying to close a construction loan.
I'm curious. Oh, go ahead, Chuck.
I was just going to say probably all of the above. I think we kind of started off talking about trends, and I can't remember who said it, but it's a lot more upfront questions, I think, when we're looking at, new developments. We're, as lenders and as investors, trying to, marry projections with what we're seeing in our own portfolios, and what we're seeing with other partners, maybe in a similar geographic area or with a similar tenancy type. But I think we're just doing a lot more upfront work in trying to get closer to what we think is a realistic expectation by the time that that project is complete. And some of that is using our own portfolio, some of that is using our developer partners' portfolios, some of that is kind of what we're seeing with similar type properties in a similar geographic area. So I think a little bit of all of it, and then just more questions and back and forth conversations, which I think is good for us as lenders and investors, but is also good for our developer partners too, because there's deep pipelines with some of our partners, and they want to be able to know how to kind of look at some of the other projects that might be similar. So I might say something on a project that US Bank is looking at. Maybe Ari and Debbie have similar questions on, but then it's kind of this holistic, hey, we're all asking similar questions to try and find out, to try and figure out how we can be as close as possible once operations start.
Insurance, Daniel, definitely is like we're wanting substantiation from actual brokers on what the insurance is going to be, because that always seems to be a big bust at perm conversion over the last few years, substantially to the point of deleveraging a project, potentially. Understanding what the staffing plan actually looks like in terms of FTEs and salaries being paid, and being proposed to be paid, because I think I said earlier, like we saw like pretty significant payroll growth occur over the last 5 years at properties. Inflation was up and wages were up too. That's moderating, but often getting surprises on utilities. So yeah, digging into what the applicable utility rates are going to be on the project, and kind of usage patterns in the rest of the sponsors' kind of portfolio on that, because that's one that doesn't seem to be slowing down, particularly electric, right? Like we're building more efficient projects, but the utilities keep raising the rates, right? So we're running in place to a certain degree, because they're trying to recoup back for their investors what they're losing by the fact that we're making all our buildings more efficient and putting solar arrays on them. And I admit there's probably slight editorial in my comment on that one, particularly around PHME. So yeah, I think that's getting a deeper dive, Daniel, over the last few years than maybe in the past, definitely. And then to that question about the inflators, I mean, we're still kind of all using our standard like assumptions, which for us is like 2% on income and 3% on expenses, which even though it's only 1% difference, the same as the TCAC standards, is actually slightly more conservative. Just the math works out that way. When you inflate the income slightly lower, even if you're inflating the expenses slightly lower, it's still more conservative. But like what you're not seeing is us stress testing that, like how big of kind of increase on things like insurance and the like kind of project absorb over that 15 years before it starts to crash. So we're doing more of that kind of sensitivity modeling behind the scenes maybe than we might have in the past. Particularly on deals with no perm debt PSH with the coasters, as I mentioned earlier, because they don't have an ability to like change anything. Like if OpEx at conversion is higher than budgeted when we closed, it's a painful solution, but there's a perm loan to reduce, right? So to right size NOI, but you can't really do that with a coaster funded project, right? The coaster amount's kind of set at closing, and it's set up, it's sized to last a certain period of time based on certain operating assumptions. And if those operating assumptions are kind of blown at stabilization, now you're in a position where you don't really have an immediate toggle to be able to show the project's going to kind of operate positive cash flow, because your cash flow source is the coaster is like a fixed number. So we're super sensitive on like making sure the budget's right sized on those kinds of deals on the front end.
As a follow-up, I'm kind of curious in terms of your underwriting, are you looking at expense to income ratios? And has that changed recently in terms of your underwriting?
Only for non-perm debt deals. We do look at that for ones that don't have perm debt as opposed to a DSCR test, but our ratios have not changed, no, at least for us. It's more like Ari said, we're just beating up the operating budget instead on the front end more. Yeah.
I don't know about beating it up, David, but I would I would say, especially around insurance, we're really curious.
Thank you.
Curious is a good way, right? Yeah. But yeah, it used to be, right? We, we get the operating expenses total. If it's okay, we're kind of okay. But now it's like, okay, how much, what's the FTEs? What's your service, what your service budget includes? And, insurance, oh, if it's too low, well, what is this based upon? Kind of like more questions like Chuck said. But also that, expenses and incomes ratio, it's like over the term of the loan. How would that, if it's declining, it's you really need to have good cushion because otherwise, when the time comes to convert, it's even tighter. And the last thing we want to do is to reduce the perm. So.
And and Daniel, like you and folks, you might see more digging from your investor. And like you're wondering, like, why is my investor in particular being so pokey about this? We don't have a lien position. That's why we're pokey. Particularly, your perm lender has a lien position. The loan to value for the perm loan is probably pretty low, right? Just functionally, like these are not large perm loans in the world of real estate on a per unit basis, typically. The Section 8 deals are a little bit different, especially if they're like Section 8 heavy, but typically the perm loans aren't huge, right? So, they are restricted, income restricted, rent restricted properties, but there's still some collateral that the perm lender's in first lien position for. And if they foreclose, they could, depending on how the reg agreements are structured, wipe those out. Whereas, as an investor, I have no lien position. What I have is a guarantee from the sponsor, which is still something, but it's not a security interest against collateral. And so our collateral, analysis is making sure that that we've done a really good job on the due diligence, because if things do go sideways, we are last in line for recouping our investment, and behind all the other lenders, including the public agency lenders, who also likely will not get repaid, more likely not in a foreclosure, because these are at the end of the day affordable housing properties. So that's often why you see from your investor, you might see a more digging in on those kind of assumptions.
Yeah, we like you to be pokey, right?
Yeah.
And that's why we like to have investors, having a kind of second set of eyes, non-LIHTC deals. Lender needs to be the one to go through all that. So.
I
Go ahead, Daniel.
I was gonna say, I think maybe perhaps we're moving towards wrapping up, and if we can have all our panelists maybe say provide some closing remarks as we wrap up, if folks are okay with that, that'd be great. So why don't we start with Chuck?
Oh, thank you for the time. I think Daniel said earlier on, we'll all be at the conference tomorrow. Looking forward to seeing many of you there. So if there are any lingering or burning questions for any of us, I know I'm offering my colleagues time and energy, but I think all of us would be happy to kind of talk about individual projects or anything that we went over today, or if you have any ideas for how us as lenders and investors can become more involved. So thank you again for the time. I'll pass it to Ari.
Yep, thanks for the, for inviting me to the panel. This is great discussion and look forward to seeing you all tonight and tomorrow. Yep, it's despite all of that, it's exciting time to be in affordable housing business and look forward to, closing more deals next year.
Yeah, great discussion. Thank you, everyone. Thank you to SCAMP for giving us the opportunity to talk about our work. And I also am looking forward to a good conference with you all. And I am at booth 2, so come say hi.
Thank you all. We're
Yep.
looking forward to seeing you tomorrow.
Thank you.
Thanks, everyone. See you tomorrow.
See everyone tomorrow.
Thank you.